France has more than $3 trillion in debt, 5 prime ministers in less than 2 years, and a political system where the only moments all three factions agree is when they unite to bring down the current government. And yet no one is calling it a crisis. They are calling it politics. That is precisely the problem. Debt has crossed 113% of GDP and is on track to reach 130% by 2030. The annual cost of servicing that debt will exceed the combined budgets for education and defense, and growth, which for decades sustained the model, barely reached 1% in 2024. What is ending in France is not a bad political cycle. It is a miracle. For half a century, the country built something that economics textbooks tend to consider impossible, a state capable of redistributing wealth at scale, measurably reducing inequality and maintaining social cohesion, all while running one of the world's largest economies. The model had a coherent internal logic, and for decades it worked. The problem is that the bill for decades of postponement is arriving at the same moment the political system has made any meaningful reform a virtually impossible mission. Serious economists in Paris are already using the language of IMF intervention, not as a doomsday hypothesis, but as a scenario that can no longer be ruled out. How did a model that worked for 50 years reach this point? What are the three fronts on which the collapse is happening simultaneously? And what is at stake for the euro and for Europe if France cannot find a way out? In October 2025, Italian newspapers published something France did not expect. It was not a diplomatic crisis. It was not a trade dispute. It was pure mockery. Headlines like, "And now where's the grandeur?" appeared in publications that normally ignore French domestic politics. Italy, the country the rest of Europe uses as its reference for political chaos, disposable prime ministers, and unpayable debt, was laughing at France. And the most uncomfortable part is that it had good reason to. In less than 2 years, France had gone through 5 prime ministers. Parliament is so fragmented that the only moments when its three factions agree is when they unite to bring down the current government. Public debt has crossed 113% of GDP and is on its way to 130% by 2030. The spreads on French government bonds, the thermometer markets used to measure sovereign risk, are closer to Italian levels than at any point in recent decades. You might say, this is a temporary crisis. Every democracy has its moments. France has been through worse, not this time. What is ending is not a political cycle. It is a miracle. And to understand why that matters, you need to understand what that miracle actually was. France built something that economics textbooks tend to consider impossible. A state capable of redistributing wealth at scale, reducing inequality in measurable ways, and maintaining social cohesion even during periods of economic turbulence, all while keeping one of the world's largest economies functioning. France's Gini coefficient after taxes and transfers is among the lowest of any developed country. Its public healthcare system was for decades a global benchmark. The transport networks, nuclear energy infrastructure, defense industry, all built with public resources by a state that knew what it wanted and had a parliamentary majority to want it. The model had a coherent internal logic. High public spending generated domestic demand, stable employment, and social cohesion. Social cohesion generated tax revenue. Tax revenue funded the spending. The cycle closed, and for decades it did. For 50 years, every government, left and right, used public spending to put out the fires of discontent and buy social peace. It was not irresponsibility. It was the method. And the method worked as long as economic growth was strong enough to sustain the cycle. The problem is that French public debt has been growing since the 1970s, when the social protection model was expanded beyond what the tax base could structurally sustain. GDP grew. Spending grew faster. The difference was covered with debt. For decades, this was manageable. Growth above potential, low interest rates, market credibility. But each crisis added a layer of debt without a corresponding reduction in structural spending. The 2008 financial crisis, the 2020 pandemic, the 2022 energy shock. Each time the cycle threatened to break. Each time the government found a way to delay the bill. Until July 2024, when Macron dissolved Parliament, the most expensive political bet in modern French history, and turned a serious fiscal problem into an institutional paralysis with no end date in sight. The miracle did not end suddenly. It was being corroded from below, and now you're going to see the three fronts on which that is happening at the same time. Imagine a company with decent revenue and reasonable operations, but one that spends more than it earns before even paying the interest on the loans it already has. Every month, the outstanding balance grows. As the balance grows, the interest grows with it. As the interest grows, the deficit increases further. No new crisis, no external shock, just compound mathematics operating silently over time until the numbers become impossible to ignore. That is what is happening to French public finances. The budget deficit reached 5.8% of GDP in 2024, large by historical standards, and relative to an economy that is not in recession. And unlike Italy or Greece, where large interest payments hide primary surpluses, France is running one of the largest primary deficits among developed economies, 3.8% of GDP. This means the country is spending more than it earns before even paying the interest on the debt it already has. The bill is growing before it even reaches the credit card. In 2020, the annual cost of servicing the public debt was 36 billion euros. By 2026, it is expected to reach 59 billion. By the end of the decade, projections point to 100 billion a year, surpassing the combined budgets for education and defense. Think about that. France will spend more paying the interest on past debt than investing in the present of anything. That is the definition of a fiscal trap. And to escape that trap, France would need a primary surplus of between 1% and 2% of GDP to have a robust buffer against economic shocks, something that has been a rare occurrence in French post-war history, even with functioning parliaments, solid majorities, and strong growth. France is on the opposite side, a primary deficit of 3.4% projected for the coming years. The necessary adjustment is 4 to 5 percentage points. Markets are already pricing in that this adjustment is not going to happen. Rating agencies have downgraded French debt. Spreads against German bonds are at their closest to Italian levels in decades, meaning investors are beginning to put France and Italy in the same risk basket. For a country that saw itself as a benchmark of European fiscal stability, this is a quiet humiliation with very loud financial consequences. It is like standing on a dike that looks solid. Everyone stays on top of it saying it is solid. But underneath, the sea is eroding it, until one day everything suddenly collapses. The problem with dikes corroded from below is that they look intact right up until the moment they are not. The fiscal crisis would be difficult to resolve in any political environment. In the current political environment, it is virtually unsolvable. Understand the mechanics. To pass a budget, the government needs to unite its centrista bloc with moderates on the right and left. But every concession to one side makes it mathematically more likely that the other walks out. The left wants a wealth tax on households with assets above 100 million euros and the reversal of the 2023 pension reform. The conservative right threatens to vote against any budget that includes those measures. And at the extremes, far right and far left, there are parties that will shout betrayal at the slightest sign of compromise with the center. It is an equilibrium where every player has an incentive not to yield, even though the collective outcome is total paralysis. What happened to the 2023 pension reform is the most concrete example of the cost of this paralysis. That reform, which raised the retirement age from 62 to 64, was supposed to generate 11 billion euros in annual savings by 2027. It cost months of demonstrations, national strikes, and political turbulence to get passed. And today, after subsequent political adjustments and retreats, it is expected to deliver just 100 million euros in savings in 2026. Read that again. From 11 billion promised to 100 million delivered, a 99% difference. The reform that nearly brought down the government delivers less than 1% of what it promised. If that is what happens with the most politically costly reform of the past decade, think about what it signals for any future attempt to cut structural spending. The timing that makes everything worse is simple. Macron has less than 2 years left in his mandate. Municipal elections are in March. Presidential elections are in May 2027. No politician with any electoral ambition has any incentive to embrace cuts that could compromise their candidacy. The electoral calendar has turned any serious reform into political suicide. And there is a direct fiscal cost to this paralysis that people tend to ignore. Political uncertainty is adding a premium to French sovereign debt. France is paying more to borrow than its economic fundamentals would justify, and part of that extra cost is purely political. Every month of deadlock is extra money leaving the budget just to finance indecision. Paralysis is not free. It comes with a bill that arrives every month in interest. The sovereignty and freedom of France and Europe are at stake, and France finds itself paralyzed by chaos, impotence, and debt. Since October 2025, when that diagnosis was first delivered, yet another government has fallen. Below the fiscal and political crises is a third layer, the deepest, the only one without a quick solution even if the other two were resolved tomorrow. France never carried out the structural reforms needed to keep its economy competitive in a world that changed. While the miracle lasted, this was tolerable. Now that growth can no longer sustain the model, the bill from decades of postponement is arriving. Think of a 25-year-old French person trying to enter the labor market. They compete with candidates who have old contracts, seniority-based protections, and unemployment benefits that take 2 years to decrease significantly. The result is not abstract. The employment rate of young people and older workers is too low compared to Northern European countries. Unemployment is expected to rise from 7.7% in 2025 to 8.2% by 2027, high for an economy not technically in recession. The market cannot reorganize fast enough because it was designed to protect those already inside, not to let in those waiting outside. And public money is not going where the return would be greatest. Think of a hospital manager trying to justify their budget. France spends more than most European peers on healthcare and does not rank at the top for life expectancy or infant mortality. Housing subsidies cost billions a year and have not reduced the share of household budgets going to rent. Research and development tax credits flow mainly to large companies, not the small and medium enterprises with the greatest potential for innovation. More public money being spent, less efficiency being delivered. It is the inverse logic of the miracle distributed well. What remains distributes expensively. There's a revealing detail that analysts have flagged as a long-term warning signal: the decline in mathematical skills among French students. Estimates suggest that a response similar to what Germany did when its poor results in international tests drove significant educational reforms in the 2000s could add 0.2 percentage points to French growth. That sounds small. In an economy growing below 1%, it is the difference between stagnation and movement. And the growth that barely exists is the final result of all these accumulated structural failures. GDP grew just 1.1% in 2024. And part of that was the temporary effect of the Paris Olympics, an impulse that does not repeat. Projections for 2026 are just 0.9%. Business confidence has been below its long-term average since August 2024. Consumer confidence hit its lowest level since the start of Russia's war against Ukraine. Meaningful progress is unlikely in the near term, given the ongoing political deadlock. The outlook could only improve if political uncertainty abates. For instance, after the presidential elections of 2027. Translation: the best hope for structural reform is 2 years away, and it depends on an electoral outcome nobody can predict. The end of a miracle does not look like a collapse. It looks like deterioration. One worse data point per quarter, one rating downgrade per year, one more prime minister every few months. Debt rising while growth falls, interest costs surpassing the budget of one ministry, then another. It looks manageable, until it no longer is. The virtuous cycle that sustained the French model for half a century is becoming a vicious cycle with its own mechanics. Rising debt generates higher service costs, which increase the deficit, which raises the debt further, which compresses fiscal space for productive investment, which reduces growth potential, which makes it even harder to stabilize the debt. And the cycle feeds itself without needing any new external shock to keep getting worse. It already has its own fuel. Projections place French debt at nearly 130% of GDP by 2030, diverging from the consolidation paths seen across the rest of the eurozone. France is doing the opposite of what its European partners are managing to do. This matters far beyond France's borders. Italy and Greece went through sovereign debt crises that threatened the existence of the euro. France is on a much larger scale than either of them. If markets start questioning the French fiscal trajectory more aggressively, the eurozone's stabilization mechanisms will be tested in a way they have not been since 2012. Serious economists in Paris are already using the language of IMF intervention, not as a catastrophist hypothesis, but as a scenario that needs to be taken seriously, one that can no longer be dismissed with a wave of the hand. This system has run its course. We are at the end of the old welfare state, but nobody wants to pay the price or face the reforms that need to be made. France has more than 3 trillion euros in debt, 5 prime ministers in 2 years, growth below 1%, a political system that punishes anyone who proposes solutions, and a half-century model that worked because growth financed spending. And that is now trapped in a moment where growth is not coming at the speed that spending demands. The dike still looks solid. Everyone stays on top, saying it is solid. But underneath, the sea is eroding it. The question is not whether the miracle is over. It is whether France will choose what comes next, before the dike decides for it.